So imagine you're walking into like a massive electronics store.
Yeah.
And on this one giant 8K television screen, you're watching this really sleek, high-budget sci-fi movie. Spaceships are launching into orbit. AI is solving impossible math problems. Just, digital expansion that looks absolutely
Right,
limitless.
the whole utopian tech dream.
Exactly. But then on the screen right next to it, playing at the exact same time, is this gritty documentary about a massive traffic jam, a broken supply chain, and like real people struggling to just afford their groceries.
Wow, yeah. That visual actually perfectly captures the absolute split-screen reality of the global economy right now.
It really does.
I mean, we are watching this limitless digital expansion completely collide with these brutal, unforgiving physical constraints. And, well, it's completely disorienting for anyone trying to make sense of the daily headlines.
Which is exactly our mission for this briefing today. We're going to unpack the economic storytelling behind the numbers, basically translating all that analyst jargon into plain human language so you can see the hidden forces shaping your wallet and the world.
Absolutely.
But keeping in mind, our conversation is strictly for context and education. We are absolutely not giving investment advice today. No recommendations to buy, sell, hold, or, time the market.
Right, just making sense of it all.
Exactly. And as always, you can find this session and more at clareandhoratio.com, which is your home for financial candy, our free thinking daily world briefs, those brain candy rabbit holes we all love, and classic audiobooks.
So that contrast you mentioned between the digital and physical worlds, it's playing out most dramatically in the semiconductor space right now. I mean, the valuations we're seeing are almost difficult to process.
Oh, they're staggering.
Yeah. SK Hynix and Micron just crossed the $1 trillion valuation mark.
A trillion.
A trillion. And Samsung hit 1.34 trillion. Taiwan Semiconductor, or TSM, well, they just hit a 52-week high.
And the scale of capital being deployed to build out these AI data centers is just, it's wild. Take NVIDIA's spending in Taiwan as an example.
Yeah.
Just a few years ago, they were spending roughly $10 billion annually. Today, that number has ballooned to around $100 billion.
And to 100,
It's massive. And that's not just money changing hands in the ether, That represents physical foundries, huge power grid demands, and a highly specialized workforce. TSM recently announced that profit-sharing payouts for their employees in Taiwan are jumping by more than 30% this year.
Well, and hardware is only half the equation, really.
Yeah.
The software side, specifically cybersecurity, is entering a completely new paradigm.
Oh, the Puntuon competition.
Exactly, the Puntuon competition in Berlin. So this is the premier event where ethical hackers compete to find software vulnerabilities before, malicious actors can exploit them.
Right.
And a champion hacker who goes by Chompy won major prizes, but she's actively warning that human intuition is fundamentally losing ground to automated processing power.
Yeah, she was pointing directly at AI tools like Claude Mythos, right?
Right. Anthropic claims this system found 1,600 vulnerabilities across hundreds of programs in just a fraction of the time it would take a human.
It's basically like replacing a team of detectives looking for a needle in a haystack with an industrial electromagnet. The AI just pulls all the obvious metal out of the hay instantly.
That is a great way to put it, and that totally changes the fundamental mechanics of the cybersecurity labor market. I mean, the low-hanging fruit is just vanishing.
Gone.
Yeah. For digital defense, having an AI instantly patch thousands of routine vulnerabilities is fantastic. But for human bug hunters, it means the entry-level and mid-tier work is just wiped out. Only the absolute elite human hackers will be employed to find the highly complex, abstract vulnerabilities that an AI fails to recognize.
You'd think that with AI transforming security so efficiently, the companies building these tools would be untouchable on Wall Street.
You would think so, yeah.
But the market is incredibly unforgiving right now. Look at Zscaler. They just beat their revenue estimates, pulling in over $850 million, and they boast massive momentum in AI-driven security. Yet their stock fell nearly 25% pre-market.
25%. I mean, Zscaler is a perfect example of what happens when perfection is already priced into a stock.
Right.
When a company is valued at a massive premium based on hypergrowth, the market demands absolute certainty. Zscaler announced some upcoming leadership transitions and offered future guidance that was slightly less aggressive than analysts hoped.
So the algorithms just panicked.
Basically, yeah. When future revenue becomes slightly unquantifiable, algorithmic trading models sell first and ask questions later. The underlying business is strong, but the valuation math breaks down the second uncertainty is introduced.
Well, and there's also a massive structural shift happening behind the scenes to fund all of this. Lawrence Gillum over at LPL Financial pointed out that the AI boom is moving away from the equity markets and flooding into the corporate bond market.
This is huge.
It is. We are looking at up to $2.25 trillion in expected corporate bond issuance.
Because tech giants need massive amounts of immediate cash to build physical data centers, right?
Exactly.
And issuing equity selling more stock dilutes current shareholders who are demanding immediate returns.
Yeah.
So issuing corporate bonds is essentially taking out a massive structured loan. It locks in their capital costs and reshapes the entire fixed income landscape.
Yeah.
It's moving the risk of this AI build-out from tech investors over to debt buyers.
So we've talked about trillion-dollar valuations and robotic hackers, but the human reality of this digital boom is starting to, well, fracture.
Yeah.
Bill Winters, the boss at Standard Chartered, recently had to issue a public apology after speaking at a conference. He referred to employees whose jobs are vulnerable to automation as, quote, lower-value human capital.
Oof. Now, his office later clarified that he was referring to lower-value roles, not the people themselves, and they reiterated the bank's commitment to retraining their staff for the new economy.
I mean, I'm not buying that corporate spin for a second, honestly. When a CEO uses the phrase lower-value human capital, that's not a slip of the tongue. That's the quiet part being said out loud by corporate boards everywhere.
Do you think they just see it as an inefficiency?
Absolutely. They view administrative and routine digital labor as an expensive inefficiency that AI can just solve.
And the downstream effect of that attitude is the rapid expansion of the gig economy. There's a fascinating profile in the sources of a graphic designer in Bristol.
Oh, I read this.
Yeah, she lost her traditional, stable client base, not because she lacked talent, but because her clients realized they could use accessible, automated tools like Canva to generate their own marketing materials for a fraction of the cost.
And to survive the rising cost of living, she had to join the UK's growing 1 million strong multi-job workforce. She's picking up reception shifts and bar work just to keep her design business afloat. It is. We are seeing a real fragmentation of traditional careers, where people have to cobble together multiple physical jobs because their digital skills have been commoditized.
Right. Though we do have to weigh that harsh reality against the undeniable good this processing power can achieve elsewhere.
True, like in medicine.
Exactly. At the UK Dementia Research Institute, scientists are feeding AI massive, complex data sets, voice recordings, eye scans, lab-grown brain cell reactions, and they aren't trying to invent a new drug from scratch.
They're repurposing.
Yes, they're using AI to find new applications for drugs that are already approved for human use.
Specifically targeting motor neuron disease and Parkinson's. Because the drugs have already passed the rigorous Phase 1 safety trials for human consumption, finding a match through AI cuts the discovery and trial timeline down from decades to just a few years.
That's a nominal application of raw computing power.
It really is. But the moment we step out of that boundless digital cloud, we crash immediately into the physical constraints of the real world.
The split screen again.
Exactly. Geopolitics is currently operating as a massive inflationary choke point. In the U.S., Federal Reserve Chair Kevin Warsh was just sworn in at the White House, and President Trump publicly urged him to be totally independent while simultaneously demanding a booming economy.
Which is a tough spot. Warsh is essentially walking into a trap. The Fed recently had to delay expected rate cuts, and the reason has nothing to do with domestic policy. It's entirely physical.
The conflict in the Middle East.
Yeah, the U.S.-Israel war with Iran is driving up inflation by choking off global energy supplies. Iran has effectively blocked the Strait of Hormuz.
And the geography of that strait makes it one of the most critical bottlenecks on the entire planet. Roughly 20% of the world's oil and liquefied natural gas flows through that specific waterway.
20%.
Yeah, you cannot simply reroute massive oil tankers around it efficiently. I mean, oil prices did slide about 5.5% down to around $97.70 a barrel on hopes of a peace deal brokered by the Trump administration. But, hope does not move cargo. The physical supply chain is still severely disrupted.
And if you're looking at your household budget, this translates directly to your bottom line. In the UK, household energy bills are officially capped to rise 13% in July.
Wow!
Yeah, which adds an extra £221 a year to the average bill. And the travel industry is virtually paralyzed in key regions. Dubai, which is a massive global hub that usually handles 92 million passengers, has faced widespread grounded flights.
And Europe is facing an even more severe jet fuel shortage, right? With prices hitting over $1,838 per ton.
It exposes a massive structural vulnerability. Europe recently closed 5 of its own oil refineries to meet environmental targets.
Oh, so they rely on imports now.
Exactly. They no longer have the domestic capacity to refine enough crude oil into specialized jet fuel. They rely heavily on importing the finished product from the Gulf. When the Strait of Hormuz closes, Europe's aviation sector simply runs dry.
And the pressure of these physical energy constraints is causing absolute panic in legacy boardrooms. BP just orchestrated an abrupt corporate shuffle, ousting their chairman, Albert Manifold, for what was described as bullying and overbearing behavior.
Right.
But what's crucial to understand is that Manifold was brought in specifically to pivot BP away from their expensive renewable energy initiatives and drive them aggressively back to legacy oil and gas. The internal friction at these energy giants is immense right now.
And that friction eventually trickles down to the most basic items in your shopping cart. There's a staggering statistic in the retail data. A simple glass of orange juice at a restaurant can now cost £5.30.
Wait, for one glass? That feels like a typo.
It sounds like one, but the mechanics behind it show a perfect storm of physical constraints. Florida's orange groves have been totally decimated by climate-driven drought and a bacterial disease called citrus greening.
Right.
You combine that massive drop in crop yield with new packaging taxes and international trade tariffs, and the price of frozen orange concentrate on global markets hit a record $5.30 per pound.
And the dairy industry is facing a similar mathematical crisis. UK dairy farmers are currently selling milk below the physical cost of production, receiving just 32 to 35 pence a liter.
Because of input costs.
Exactly, their input costs skyrocketed. The red diesel they use to run their farm equipment spiked massively due to the conflict in the Middle East. Like, you cannot run a tractor on an algorithm.
No, you can't. And when the cost of producing and moving physical goods gets this high, the retail model breaks. Morrison's just announced they're closing 100 of their convenience stores.
100 stores.
100. And they explicitly blame the math of government policy choices, pointing directly to national living wage increases and national insurance hikes. When your margin on a pint of milk is already negative, a mandatory increase in labor costs forces you to shut the doors.
So where does capital go when the physical economy on the ground becomes this difficult to navigate? It goes upward.
To space.
To space. SpaceX is preparing for a historic IPO with an estimated valuation of $1.25 trillion. This follows their highly successful Starship V3 test flight, proving they can deploy massive payloads into low Earth orbit efficiently.
And that sheer gravity of capital is pulling adjacent space stocks up with it, too. AST Space Mobile jumped 6.47% pre-market. If you look at their year-over-year growth, they're up an incredible 381%.
That's huge.
It is, and they achieved this despite having high short interest.
The mechanics of short interest are really fascinating here. Institutional investors were betting heavily that AST Space Mobile stock would fall. That's what shorting a stock means. But AST is building tech that connects standard mobile phones directly to satellites, bypassing cell towers entirely. So when the company hit operational milestones, the stock price went up instead of down. The investors who bet against it were forced to buy shares to cover their losing bets, which created a buying frenzy that drove the price up even further. It is a classic short squeeze.
Yeah. Spire Global is seeing a similar surge, up 7.71%, after announcing a partnership with Schaeffler to manufacture satellites in Germany. There is a genuine gold rush happening in low Earth orbit right now.
Oh, sure.
But back on Earth, the transition to next-generation infrastructure is incredibly uneven. Plug Power is advancing a 30-megawatt green hydrogen project in the UK. They've moved past the press release phase and are actually delivering physical equipment.
You also see companies like Semtech surging, up 324% in 12 months. They provide the critical semiconductor infrastructure needed to physically connect these massive data centers. But financial analysts are noting that Semtech's Relative Strength Index, or RSI, is pushing into overbought territory.
Right, and for context, the RSI is basically a speedometer for a stock's price movement. When it flashes overbought, it means the algorithmic buying has run the price up so fast that historical math suggests a pullback is imminent. It's like a sprinter trying to maintain an ultramarathon pace. The momentum is undeniable, but it might be temporarily exhausted.
But the green transition is absolutely not a guaranteed success story across the board. Ferrari's recent stock slump is a perfect example of consumers dictating terms. Ferrari unveiled their first fully electric car, the Luce, with a price tag of
And the
$640,000.
market response was brutal.
Brutal. It proves a very vital point. Even elite legacy luxury brands cannot force consumers into electric vehicles if the buyer fundamentally wants the roar of a V12 engine. You cannot engineer desire.
Exactly. And that unpredictable consumer behavior forces global capital to constantly hedge its risks by shifting across borders. We're seeing a fascinating trend with Indian billionaires.
Oh, with them buying Western assets.
Yeah. Domestic growth and foreign direct investment within India are beginning to slow down. To protect their wealth, these billionaires are aggressively buying Western assets. Sun Pharma's acquisition of Organon for $11.75 billion is the perfect example.
Right.
They're buying massive foreign companies to secure physical supply chains and hedge against their own domestic economic slowdown.
While on the other end of the spectrum, Saudi Arabia is hitting a harsh reality check. They are scaling back their massive Vision 2030 projects. These were those hyper-ambitious sci-fi mega projects like The Line, which was designed as a 100-mile-long mirrored city in the desert, and The Cube.
Yeah, I remember seeing the renderings for those.
Right, but they are abandoning or shrinking these visions because oil constraints and lower-than-expected foreign investment have forced them into a much more pragmatic, execution-led phase. You can draw a rendering of a mirrored city easily, but pouring the concrete requires actual capital.
Very true.
Before we move off the corporate ledger, I need to issue a quick PR noise alert. There was a press release circulating today from a law firm called Johnson Fistel. They announced an investigation into Wave Life Sciences on behalf of investors who suffered stock losses after a recent clinical trial update.
Okay.
Let me translate the mechanics of this for you. This is classic lawsuit bait. It is promotional filler generated by automated PR wire services designed to find disgruntled plaintiffs so the firm can launch a class action suit. It is not regulatory news. Never build an investment thesis on ambulance-chasing press releases.
Yeah, filtering out that kind of institutional noise is essential when reading market data.
Totally. Let's run through a quick check of corporate housekeeping just to give you the broader context of the week. Paramount and Warner Brothers Discovery are inching closer to a $110 billion mega merger. Senator Elizabeth Warren is raising massive antitrust fears about this level of media consolidation, but the talks are progressing.
Right.
LPL Financial is actively absorbing Soundview Wealth Management to position themselves for the massive, multi-generational wealth transfer expected over the next decade. And the Electronica Fast Forward 2026 platform is currently taking applications actively looking to fund deep tech hardware startups across Europe.
And those structural corporate moves bring us directly to the severe shifts happening in the UK's social and labor landscape. We are looking at a genuine crisis in the entry-level job market.
Yeah, Simon Wolfson, the CEO of Next, and the UK boss of Amazon are both sounding the alarm on youth unemployment, which has spiked to 16.2%. The physical reality on the ground is stark. Next is now seeing 19 applicants for every single entry-level retail job they post.
19.
Yeah, and just 2 years ago, that number was 10.
Well, this ties directly into the findings of the Alan Milburn report. The statistics reveal a massive systemic failure. The UK government currently spends 25 times more money on paying out benefits for young people than it does on programs designed to actually help them secure employment.
25 times the budget goes to managing the problem rather than solving it.
Exactly. And the Amazon boss is not blaming the younger generation for this. He's blaming the educational system. He is demanding mandatory work experience for everyone over the age of 16 to fix the skills gap, basically because schools aren't preparing students for the physical realities of a workplace.
Concurrently, the UK government is tightening its regulatory grip across multiple facets of society. Prime Minister Keir Starmer recently met with bereaved parents and is seriously considering implementing a total ban on social media access for children under 16, despite aggressive pushback and lobbying from tech companies.
We're also seeing the Advertising Standards Authority step in heavily. They just banned Instagram betting advertisements that featured football stars Harry Kane and Erling Haaland, specifically because those athletes hold a strong appeal to demographics under the age of 18.
The regulatory environment is definitely shifting from passive observation to active intervention.
It is. And that interventionist environment, combined with taxation, is suffocating small businesses. The beloved UK independent brewery scene is taking a massive beating. 320 independent breweries closed their doors last year.
320 in 1 year.
Yeah. They simply cannot survive the tax burden while fighting against big brand monopolies that control the draft lines in major pubs. The surviving independent brewers are being forced to retreat and rely entirely on local on-site tap rooms to sell their beer.
It's not entirely grim on the domestic front, though. The government is finally investing £57 million to bring low-Earth satellite Wi-Fi to UK trains. By tapping into that space infrastructure we discussed earlier, they should finally eliminate the dead zones on the rail network.
That's a plus.
Yeah, but juxtapose that progress with the Post Office Horizon IT scandal, which is widely considered one of the biggest miscarriages of justice in UK history. The police investigation into that scandal might be delayed by an entire 5 years because the police force is short £16.5 million in funding.
Unbelievable. And when you lay all of this domestic friction out on the table, the labor shortages, the infrastructure delays, the small businesses folding under tax burdens, it clarifies why we are seeing a massive political pivot in the UK.
Right.
Labour Chancellor Rachel Reeves came out and explicitly stated that Brexit did deep damage to the economy. She's now actively pushing to align UK regulations much closer to the European Union in a desperate bid to stimulate their economic growth, which is currently sitting at a really sluggish 1.3%.
So when you step back and look at the sheer variety of stories we've covered today, from AI hackers instantly sweeping code to the price of milk in Somerset, a very distinct pattern emerges.
Yeah, absolutely.
We are watching the profound friction between the tangible and the intangible economies.
On one side of the ledger, capital flows effortlessly into the digital ether. Billions are pouring into AI algorithms. SpaceX is achieving trillion-dollar valuations by launching digital networks into orbit. And biotech firms are using supercomputers to bypass decades of research.
Right, the digital world scales infinitely, and it does so with almost zero friction.
But the absolute second the economy has to interact with the physical world, this system grinds against massive, expensive realities. Navigating physical oil tankers through the geopolitics of the Strait of Hormuz is dangerous and incredibly costly.
And growing oranges in Florida subjects your supply chain to weather patterns and bacterial disease. Operating a dairy farm requires physical diesel fuel. Even the simple act of finding an entry-level retail job for a teenager is fraught with regulatory hurdles and systemic educational failures.
Yeah.
The companies and the nations that are going to thrive over the next decade are not just the ones that build the fastest software, it's the ones that figure out how to bridge this gap. They have to apply infinite digital models to solve harsh, physical, real-world problems.
Because at the end of the day, you cannot eat code and you cannot heat your home with a predictive algorithm.
Exactly. Understanding these macro trends is your ultimate filter for the daily market noise. When a cybersecurity stock drops despite a revenue beat, or a grocery chain closes 100 stores due to wage hikes, you now understand the underlying mechanisms driving those headlines.
And I want to leave you with one final thought to mull over today. We are watching artificial intelligence and automation rapidly devalue human capital in the digital space, threatening the gig economy and traditional white-collar roles. At the very same time, our physical supply chains are proving to be incredibly fragile and increasingly expensive to maintain. Are we about to witness a massive societal pivot? Will the most valuable, secure, and highest-paying jobs of the future simply be the manual, physical trades that a robot fundamentally cannot perform?
It certainly makes you rethink what kind of skills have true longevity. Thank you for joining us today and letting us help you navigate the noise. Have a great day, and remember to stay curious.